Thank you very much, Maury, for this brilliant presentation. Very timely, very thought-provoking. I'm sure will spark a very interesting commentary from our panelists first, and then from the audience. And so let's move to the panelists. They don't really need introduction. They're part of this family. So let me start with the ladies. Ida, the floor is yours.
Well, good afternoon, everyone, and thank you for inviting me to join this distinguished panel. And it is indeed an honor for me to share the stage with Maurice Obstfeld, as his Kenneth Rogoff's book on international macroeconomics has been a personal favorite since my university days. And in fact, in that book, there is a chart showing how large investments in the petroleum sector and falling saving ratios in anticipation of future high earnings led to Norway's huge current account deficits in the 1970s. Then in the 1980s, an increase in savings and a reduction in investments enabled Norway to repay its debt, turning the current account balance positive. So this shift in the current account, driven by intertemporal substitution, was enabled by access to international financial markets, as funding investments in the petroleum sector solely through domestic savings would have been challenging. And in later years, Norway has used the same international financial markets to invest its oil revenues abroad and save for future generations. So this is just one textbook example of the benefits of global economic integration, both through trade in goods and services, but also through capital mobility and financial integration. Now, as laid out by Professor Obstfeld, the international monetary and financial system that underpins these gains is now at a critical juncture. Now, while the ultimate consequences of the changes presently unfolding remain ambiguous, we do face the risk of a more fragmented, less multilateral, and more shock-prone world. Now, our response as a central bank in a small open economy is to remain focused on our core mandates while continuing to promote international cooperation. So let me highlight three key aspects of this response. Now, first, in the face of heightened uncertainty, central banks' commitment to keep inflation low and stable remains crucial. Like many small currencies, the Norwegian krone tends to depreciate during periods of elevated global risk. And in recent years, a depreciation of the krone has amplified the pass-through of foreign price shocks to inflation in Norway. And while our floating exchange rate regime allows us to set a different policy rate than our trading partners, this independence relies on confidence in our ability to stabilize inflation around target. Without such confidence, risk premium shocks that weaken the currency could quickly become self-reinforcing, leading to higher inflation and further depreciation. In the event of abrupt shifts to global currency markets, this could make the job of keeping inflation expectations anchored more challenging, but no less important. Second, central banks must remain steadfast in our efforts to secure financial stability. For Norway, this means maintaining high general capital and liquidity buffer requirements for banks. But we also need to be steadfast as regards international coordination in the area of financial regulation. Robust international frameworks and institutions are necessary to secure stability in a highly interconnected financial system. However, this does not imply that such frameworks or institutions are beyond the scope for reform. Rather, we should seize this opportunity to sustain cooperation and coordination by improving regulation. We could increase both the efficiency and legitimacy of regulation by exploring ways to simplify current rules, while making sure that that does not come at the expense of a less resilient financial system. Third, we must strengthen our payment systems to address risks posed by new forms of money. Stablecoins are increasingly finding use in the real economy and may present a source of systemic risk. And most stablecoins are denominated in US dollars. As highlighted by Professor Obstfeld and in the BIS annual economic report, a widespread adoption of stablecoins could pose concerns for monetary sovereignty. And to safeguard monetary sovereignty, it is essential to ensure that our national payment systems remain resilient and meet users' needs. And this requires systems that adapt to evolving standards. In Norway, technological advances and changes in our neighboring countries' settlement systems have made it necessary for us to evaluate the future design of Norway's settlement system. Our assessment is that collaboration with Nordic and other European central banks is the best choice to ensure the secure and stable operation of the settlement system in the long term. And one specific outcome of this assessment is that Norway will eventually participate in the target instant payment settlement. This paves the way for new domestic instant payment services, but also for new services such as cross-country instant payments. Like other central banks, Norway is also assessing whether a central bank digital currency is an appropriate instrument to ensure access to a means of settlement trusted by all, also in new payment arenas enabled by tokenization. By facilitating settlement in central bank money, possibly through the introduction of wholesale CBDCs, we can contribute to more efficient and secure transactions in tokenized assets. While we so far have seen not an urgent need for CBDCs, we will continue to explore the role of CBDCs in realizing the potential gains of tokenization. To conclude, while each of us can do a lot to keep our own house in order, cross-border operation is essential to meet the challenges of an increasingly uncertain world. As Professor Obstfeld reminded us, the international monetary and financial system is an evolving construct. It has fostered growth and stability, but not for everyone, and not without tension. International agreements should be grounded in mutual recognition of interests and a readiness to improve the system through compromise and institutional innovation. Now, Norway has long viewed active participation in multilateral organizations as essential. And while we are a small country, we do on occasion manage to make ourselves heard. In fact, at the Bretton Woods conference, the Norwegian delegation successfully gained support for a resolution that demanded the liquidation of the Bank of International Settlements at the earliest possible moment. Thankfully, that recommendation was never acted upon. Not only has the BIS survived, it has become a cornerstone of international financial cooperation. I personally deeply value the BIS as an important meeting place and a vital center for monetary and financial research. So I think, Agustín, that it's time for me to offer an overdue apology for recommending that the BIS be shut down. I'll stop there. Thank you.
Thank you. Well, thank you very much for an excellent presentation. Your apologies accepted. And so let's now move on, and let me give the floor to Andrew, please.
Thanks, Agustín. It's a great pleasure to have the opportunity to make some remarks this afternoon. Not just because I can follow a fascinating lecture. Maury, you really have painted a very rich tapestry. Actually, also because I worked for Andrew Crockett at the Bank of England about nearly 40 years ago. And as Maury set out, he was inspiring to work for. He was a very deep thinker about international economic policy and central banking. He also had a pretty incautious side to him as well, actually. One of his favourite sayings, and this was actually repeated quite a few times at his memorial service, was that he was a practitioner of one of his favourite phrases, which is, if you've never missed a plane, you obviously arrive at airports too early. Which actually, if you met Andrew, you couldn't really work that out from meeting him, but it was something he held very dear. So you really have painted a rich tapestry. So I was trying to work out and develop a theme and I've chosen one that I think does run through Maury's lecture, which is what is the meaning of the term reserve currency and what does it mean today? And to cut to chase, my conclusion is that I think it's really best to think of the term as one that has evolved with the times and continues to do so. I think thinking about the term as a constant doesn't actually help to understand its meaning, at least that was my conclusion, having thought a bit more about it. So I'm going to start actually going back a bit further than Maury went back, to start going back to the 19th century and the meaning of this term, and back to the classical gold standard and convertibility of domestic currency into gold at a fixed price, which was the nominal anchor of the system. And in that sense, the term reserve currency referred to the gold reserves that were held to enable convertibility and to underpin the promise thereof. And the 19th century Bank of England, I can also speak about this afternoon, of course, as the governor of a central bank that, has managed to sort of give up being a reserve currency in the classical sense. So, we speak with a bit of experience on this one. But the Bank of England in the 19th century spent a lot of time managing the reserve balance to create that confidence in the promise of convertibility. There is one sort of hangover today, which is our banknotes today still carry the words, "I promise to pay the bearer on demand the sum of," whichever the value of the note is. Of course, all we actually promise today is that you can have another banknote. But under the gold standard, it meant a lot more. But that system didn't put as much emphasis on financial stability. And the consequence of that was that when crises did occur, as they did in the 19th century, they were managed with a certain degree of ad hocery. And of course, that's actually the origin of Walter Bagehot's famous critique of the Bank of England, in fact. But there was also, I think, rather more to the concept of reserve currency in this period. Sterling, which was the reserve currency at the time, was the premier currency of international trade, built on trade with the British Empire. Maury alluded to the sort of decline of that. But extending further over time to the countries of the so-called sterling area. Now, I would say it's one of the questions, I think, in the central bank Trivial Pursuit pack to name the countries of the sterling area, because some of them would surprise you. The collapse of that system between the wars led, as Maury said, to the Bretton Woods system coming into existence and its heyday once full convertibility was restored. Of course, this system had effectively had the joint dollar-gold anchor in the form of a fixed dollar-gold rate and pegging of the major currencies. And the consequence was a substantial growth of official dollar reserves, as Maury's chart showed, and the further emergence, therefore, of the dollar as the reserve currency. And of course, it had, therefore, a joint anchor. And Bretton Woods solved the so-called trilemma by restricting capital flows. The threat of countries exhausting reserves was limited, but not sufficiently so to prevent difficult devaluations at times. I think we seemed to specialize in them at that time. And I tend to think of the Triffin dilemma as posing the question at that time, what if the bluff of the dollar-gold tie had been called, and what would be the consequence? Well, as Maury set out, really from the early 1970s, that system broke down. Countries moved to free float with periodic attempts at management and a lifting of restrictions on capital controls. And alongside this came the emergence of the domestic anchor of monetary policy, usually an inflation target. But the dollar had become the predominant currency of international trade and international payments by that stage. So the role and nature of reserves had changed in that sense. They were no longer the 19th century description of the central bank's balance sheet and its liquidity under the classical gold standard. Really, they were a description of so-called official reserves, typically but not always held by governments, though often managed by central banks, as we continue to do today. But their role was different. It was reflecting the changes to the solution of the trilemma. As foreign exchange intervention to influence exchange rates, though, came to an end, the role of reserves in many countries became to act as a bulwark against pressures from capital flows, as we saw obviously in a number of financial crises, if you take the Asian crisis of the late 1990s. And it's probably useful to have a few numbers here. I mean, the stock of FX reserves relative to global GDP increased from, I think, around 3% to 11% between 1976 and the latest number, which is last year. During that period, foreign currency reserves as a proportion of global reserve assets, including gold, increased from 50% to 90%, so gold declined. And the dollar's share of foreign currency reserves actually declined somewhat over that period from 80% earlier in the period of the 1970s to just a bit under 60%, I think, now. So what do I take 4 points from all that. all those figures. The total stock of foreign currency reserves has increased. The share of gold fell over time. The dollar's share also fell as it moved from being the anchor currency to being the largest currency. And the evidence further supports the view that the meaning of the term reserve currency has changed over time. So let's come on to today. Today, as we've been hearing, Ida said, we've got domestic monetary anchors. Financial stability has become the focus of international coordination, in a sense, the opposite of the gold standard arrangements in that sense. And the meaning of the reserve currency, I think, has changed again as a consequence. And I really want to draw out two important features in this sense of today's system. The first is that the concept of reserve currency, I think, has a lot more to do with the supply and denomination of safe assets now, which act as security in the financial system and are increasingly at the heart of it, much more than it did in the past. This version of the concept of reserve currency has as much to do with the role of US Treasuries as a safe asset than not just official reserves, but also to provide, in the sort of Bretton Woods sense, but also to provide security and collateral in financial markets. Second, these arrangements are backed up by the provision of contingent liquidity insurance in the form of central bank swaps and repo facility. And these arrangements really underpin the role and primacy of the reserve currency. So let me end with 2 points which strike me as unfinished or emerging. First, at least for the large economies, it could be asked today, what's the point of official reserves? My view is that today their use is more to do with preserving financial stability in the event of stress. They may be needed to support financial system liquidity in situations of extreme stress. My second point is we've had a number of discussions already over the weekend, and very valuable discussions over the weekend, is that we need to watch carefully the evolution of payment forms and whether innovation here introduces fragility into what I would call the money system, something that Hyun was talking about this morning very eloquently. So if, for instance, stable coins emerge as a new form of money, we have to decide how to ensure the singleness of money and therefore trust in money in this world, and what role the notion of reserve currency should play here. So let me finish. Maury, I just want to thank you for such a stimulating lecture. You pushed me to think further about this meaning of this term reserve currency. I think it is an important subject, and it's also a topical subject as well. My conclusion was that I think we need to think about it in the sense of its adaptable nature over time. And thereby be very clear about what it means in the world of today and what it might mean in the world of tomorrow. So thank you.
Thank you, Andrew, for this great lecture. You're so capable on reserve currencies. Fabulous. Kazuo, the floor is yours now.
Thank you from me as well to the BIS for this opportunity to comment on Maurice's excellent paper. I would also like to express my sincere appreciation to Agustín for his leadership and many valuable contributions to the BIS during these challenging times. Maurice provides a clear and thought-provoking summary of the evolution of the dollar-centric international monetary and financial system. He also raises important concerns about its future, particularly in light of recent US policy shifts. I'd like to offer just a few brief reflections to complement his discussion. First, recent US policy is driven, as Maurice pointed out, by the idea that the trade and current account deficits are unhealthy or even unsustainable, and is a result of unfair practices by its trading partners. While this paper doesn't quite focus on that issue, Maurice has addressed it elsewhere recently. I don't want to deep dive into the question today. Doing so would require that I begin with, David Hume's work on the price PC flow mechanism, which came out in 1752. It's too much for me today. So I thought if looking at the behavior of US asset prices, such as bond yields, stock prices, and foreign exchange rates, might tell us something about the sustainability of the trade or current account imbalances, or actually about the effects of US policy shifts on the economy. Actually, Maury does some of this in, I thought, slide 13 or so, by looking at the bond yields and foreign exchange rates. But it would be nice if he could add the stock market or stock prices to discuss what the whole configuration of asset prices is saying about these things. It's actually, it would be better if I could talk about this, but it's a bit too risky for me to discuss this. So I wondered if Maury could offer some thoughts. Sounds a bit unfair, but anyway. Second point I wanted to discuss is the possibility that another motivation for recent US policy shifts could be concerns about the serious burdens of adjustment imposed on import computing industries, sectors, as the structure of comparative advantage has evolved in response to new technologies and globalization. The US has gotten richer in the process, but maybe has not managed income or wealth distribution issues very well. The problem has been obviously exacerbated by the winner-takes-all nature of new technologies. These, I think, are more serious problems than imbalances themselves. I realize that there are supporters of the administration in both import computing and export sectors of the economy. I wonder if in what way policy going forward will try to seek a balance between the two. Now I come to the question discussed in the paper, which is implications of shifts in US policy for the data-centric international monetary and financial system. There are many dimensions here, but let me just focus on technology. As have been discussed, the US administration appears to be promoting dollar stable coins, as we've been saying this morning, and Maury also talked about this. If they spread across the world quickly, the demand for the dollar may strengthen despite some headwinds. And actually, these will be a threat for the monetary authorities in other countries. Alternatively, new technologies, by improving infrastructure and price discovery, may allow less liquid currencies to become a second or third international currency, thus supporting a multipolar currency world. Yet another possibility would be for the international monetary and financial system to move in the direction of more robustness that allows a flexible, say, a choice of the currency of denomination for transaction, depending on circumstances, possibly on improved interoperability across payment systems. Of course, we could have some of these on a unified ledger. With that, I hand this back to Agustín.
Thank you, Kazuo. It's great to hear one MIT mind to speak to another MIT mind. Okay, so Maury, you have heard a lot about your lecture, mostly praise. So now you have the chance to comment on some of the issues that have been mentioned.
Okay, great. So these were three very rich set of comments, which I very much appreciate, and they're also very complementary and very different. So I'm just going to address a few points because I only have a few minutes, and we can go to the Q&A and discuss more. I appreciated Ida Bache setting out very clearly the mandates of the central bank, the price stability, financial stability, the payment system, and the need, certainly in the financial stability and payment sphere for international cooperation, making that also a core mandate of the central bank. And of course, the BIS is central to these cooperative efforts. So I didn't know about that history of Bretton Woods, and I'm glad that you've patched it up today. Andrew, the issue of reserves is really fascinating, and you said a number of things that I really agree with, but I sort of a little anecdote first that you put me in mind of. I went to the Bank of England during my time as IMF economic counselor, and for some reason I had these very old sterling notes that I had brought along with me. They had sat in a drawer, and I finally remembered to bring them, and I tried to pay a taxi driver with them. And he looked at them and he started laughing, and he said, well, you have to go to the Bank of England to turn those in. I said, okay, I'll pay with a credit card. And he said, where are you going? I said, Bank of England. So we were due to go up and see Mark Carney, but there's actually a little like Kess there when you walk in. And I ran up there with my notes, and they gave me new notes. I was really, really impressed with the efficiency. And there was actually a person there, and so good job. Making good on the promise. But the reserve issue is fascinating, and in Bretton Woods, reserves were basically covering balance of payments deficits under the constraint of an exchange rate peg, what it has become, I think it's much more for many countries, is a buffer to be used in cases of financial crises, a capital account crisis, when the private capital flows dry up. And sorry to say, part of the accumulation after the late 90s was driven by the desire not to have to call in the IMF for that purpose and submit to conditionality. But an interesting fact is that the demand for reserves has kind of leveled off. It's been constant. Reserves have been pretty much constant in nominal terms since for a decade or more, and the world economy has grown in nominal terms. So it must be that countries are more comfortable relying on private capital markets. And I think probably rightly so. We saw emerging markets do well in a number of recent crises during COVID, during the rise in interest rates to combat inflation in the inflation surge. And I think that owes a lot to much more professional central bank management, the adoption of best practice in a wide set of countries, and the fact that best practice works. So that's one reason why it's so distressing to see this consensus. And I think this is a valid consensus. It's proven itself under attack in my home country. On stock prices, I thought about putting them in the chart. Part of the issue in the Treasury risk premium discussion is the correlation of stock prices with the Treasury rate, with the exchange rate, and that is something that is much less reliable for hedging purposes than it has been in the past. So I think that's a definite factor. Now, in terms of judging whether the markets think the dollar is cooked as a reserve currency, you look at the all-time high in the S&P. I'm personally very skeptical about stock market forecasting the future very well. A comment on the current account and sustainability. Sustainability analyses often look at the net international investment position. I think that's misleading because it's made up of the assets of international creditors, the liabilities of international debtors. The international creditors aren't going to get into trouble, but also their resources aren't available to pay the debtors' debts. So it's much more complex than looking at the NIIP, but we do know that there's one very big international debtor in the US, which is the federal government, and it is planning to issue more debt at a record pace. So I think that's what the worrisome issue is. It's not really an issue of the current account, it's really an issue of government finance. I'll stop there.
Thank you very much, Maury. I ask my fellow panelists if they would like to replicate or ask another question to Maury. If not, let me take the liberty to ask you a question. Simple, very easily drafted question, but very difficult to answer. But anyway, I'll put you, you always come with good ideas. So if you were to envision an ideal international monetary and financial system, what key elements would it include? 5. Just give us 5.
Well, when we say ideal, ideal is always subject to political constraints. So, in an earlier age, someone might have said, we must all be on the gold standard. And, the problem is that clashes with domestic sovereignty in a certain sense. When countries went off gold in the 1930s, Friedrich Hayek said, well, this is a slide into nationalism. It's the worst thing in the world. And, modern scholars credit this with helping to end the Great Depression. So, what our view is of what is the ideal system has to be tempered by political reality. And I think what we've seen is that political reality doesn't always lead to good domestic policies, which complicate the task of finding good policies for international relationships. I was reading a piece today from The Atlantic that my wife sent me, and it was sort of an academic explaining, how the U.S. got to its sorry political state today based on a number of economic factors. And one thing he blamed was globalization, of course, and he also blamed central bank independence, as if somehow central banks, by raising interest rates to control inflation, were impeding social progress. And I think, that's a complete misreading of what a good system would look like. So a good system would have the domestic policies that could offset the shocks from globalization, that could offset the shocks that occur when inflation stabilization is necessary. But I view both of those things, globalization, free trade, open trade, and central bank independence is critical. I think the arguments for interfering with free trade are we're talking about fourth, fifth best arguments, which is not very good. So there's certain key elements of the Washington Consensus that I would not dissent from. And I think we may have gone too far in trashing the Washington Consensus. In the financial sphere, I think that consensus was far too optimistic about the financial stability effects of capital flows, particularly when domestic systems are weaker. And so I think that's an area where we should look. I think the potential distortions in financial markets are much more serious than the distortions surrounding trade. And that's why the work you do here is so important.
Excellent. Well, thank you very much. Thank you, Maury, for this brilliant and inspiring lecture. Thank you for the panelists, and thank you all for being here. So.